Understanding late fees, what you need to know. Late fees are a common but often misunderstood aspect of personal finance. These charges can occur when consumers fail to make payments on time, affecting everything from credit cards to rent and loans. Understanding how late fees work, their potential impacts, and strategies to avoid them can help you manage your finances more effectively. What is a late fee? A late fee is a financial penalty imposed by lenders or service providers when a consumer fails to make a payment by the stipulated due date. This can apply to various financial agreements including loans, personal loans, auto loans, student loans, credit cards, monthly minimum payments, rental contracts, monthly rent payments, insurance policies, monthly or annual premium payments. Late fees serve to incentivize timely payments and can often be found explicitly stated in the contract or financial agreement. Under regulations, lenders are typically required to provide written notice of any changes to these fees. Key points to remember. Late fees can range from $25 to $50 generally, although they may vary based on the provider. The exact amount and terms regarding late fees should be clearly outlined in contracts. Late fees can lead to increased outstanding balances and adversely impact credit scores. How late fees work. When a payment deadline is missed, late fees are typically added to the next billing cycle. For example, if a credit card payment is missed, the card issuer might apply a fee the following month. These fees not only add to the total debt but may also accrue interest, meaning you could eventually pay interest on the late fee itself. Grace periods. Some lenders provide grace periods, allowing consumers a few extra days to make payments without incurring penalties. For example, a landlord might allow rent payments by the 10th of the month without imposing a fee, as long as this provision is included in the lease agreement. Impact on credit. Late payments have a profound impact on your credit score as well. Payment history accounts for approximately 35% of your FICO score. This means that repeated late payments can significantly damage your creditworthiness. Late fees not only add to the outstanding credit balance but can also raise your credit utilization ratio, further lowering your score. Additional consequences. Repeated late payments can lead lenders to increase interest rates, a practice known as penalty repricing, potentially resulting in much higher interest rates for subsequent payments. Other charges may accompany late fees, such as non-sufficient funds, NSF, fees if adequate funds are not available to cover payment obligations. Strategies to avoid late fees. Avoiding late fees requires diligence and planning. Here are several strategies. 1. Automate payments. Set up automatic payments from your bank account to ensure bills are paid on time. Just ensure you have enough balance to cover payments. 2. Pay on time. Always aim to pay credit card bills in full to avoid both interest charges and late fees. If you can't pay the full balance, at least make the minimum payment on time. 3. Monitor accounts. Regularly check your bank account and bill due dates to prevent accidental oversights. 4. Communicate with your lender. If you do incur a late fee, contact your lender. They may waive the fee, especially if this is your first missed payment. Understanding your rights. Under the Credit Card Accountability Responsibility and Disclosure (CARD) Act of 2009, lenders must ensure that late fees are reasonable and proportional to collection costs. Unfortunately, many late fees can be viewed as excessive. The Consumer Financial Protection Bureau, CFPB, has noted that these fees can accumulate significantly, costing consumers billions every year. Legislative changes and consumer protection. In March 2024, the CFPB announced a cap on credit card late fees, reducing them to $8. This move is anticipated to save approximately $220 annually per consumer currently facing late fees. This initiative has, however, faced opposition from financial institutions, arguing that it could lead to increased costs for responsible consumers. Types of penalties beyond late fees. Late fees are just one type of fee seen in the financial world. Others include annual fees, charged by credit cards that offer rewards or special benefits. Balance transfer fees, charged when transferring debt from one credit card to another. Returned payment fees, assessed when a payment is rejected due to insufficient funds. Understanding these potential costs can help consumers make informed choices regarding their financial commitments. Frequently asked questions. How much can a landlord charge for late rent? The amount a landlord can charge for late rent varies by state law. Some states impose no limits other than that the fee be deemed reasonable, while others specify maximum fees. How long do late payments stay on your credit report? Late payments can remain on credit reports for up to 7 years. Given that payment history impacts 35% of your FICO score, it's crucial to pay on time whenever possible. Does the IRS charge late fees? Yes, the IRS imposes a failure to pay penalty of 0.5% of the unpaid taxes each month, up to a maximum of 25%. Conclusion. Late fees can become a financial burden, but understanding their implications and how they are applied can help you avoid them. By paying your bills on time, keeping track of due dates, and communicating with your lenders, you can minimize the likelihood of incurring late fees and protect your financial standing. Remember, if a late fee does appear on your account unjustly, review your contract carefully and don't hesitate to reach out for a possible waiver.